Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk to you about Farfetch. So Farfetch has reported its results last night, and I want to go through that because there's a lot to unpick here. We're going to talk about its guidance, we're going to talk about its valuation, we're going to talk about its shareholder dilution. So before I kind of jump in any further, I wanted to highlight that previously I was a Farfetch shareholder, and on 14th of May, I actually wrote to the investors in the marketplace saying, I've made a bad mistake here. I should have sold in February. There was enough insight in February that I should have sold, and I am in May now, and essentially I want to take full ownership of what's happened. I can't do anything about the past, and I could have buried my head in the sand, but that's not what I'm going to do. I feel that there's enough here for me to kind of construct that it's going to get a lot worse, that there's no point me holding on to these shares. And so I was a bit ahead of my time, and I'm going to just go through and highlight what you need to think about right now. So the first most important thing is that the pace of revenue growth rate is clearly decelerating. You can see that starting with Q2 2020 all the way through to Q3 2021, there's this kind of choppy deceleration. Is kind of, the trend is undeniably clear. It went from 74% year-over-year growth all the way to 33%, okay, for this recent quarter. But that's not all. One of the things I wanted to highlight is how Farfetch's business model is driven. So it has this digital platform. This is really the key here, okay? So that's this marketplace platform. It has its brand platform that is essentially like the New Guards Group and direct consumer channel, okay? And then it has its in-store revenues, which is small. It's not really material. It's a bit of a distraction. Let's just focus. There are two essential operations here, which is the digital platform, what you need to understand. That's the marketplace business model, okay? So 83% of the GMV that comes through Farfetch comes from the digital revenues, okay? It's the digital segment, sorry. So the 83% of the GMV, okay? And what is important to understand here is if you look at the gross profit makeup, 63% comes from the digital platform again, okay? So this is really what you need to think about. How that performs, the digital platform, has an overarching impact on how the business model goes forward, okay? Now, a lot of people in the bullish camp say, Michael, you don't really understand this because the brand platform carries very attractive margins. And I show here 49% the margin that it derives on the order contribution for the brand platform. And I get that, that's fair, I understand that, but that's not really the biggest driver here when you're paying more than 16 billion in revenues, so 16 billion in market cap, okay? So I just want to unpick the guidance that they put out, okay? So what they're saying, essentially, they don't give you the guidance in terms of revenues, okay? They tell you about the GMV, but let's just use the following numbers, okay? So the brand GMV, that's the smaller part of the business, how the GMV does, that's essentially drops 100% to revenues, okay? Whereas the digital GMV comes up as 39% drops to revenues. So there's a meaningful chunk of that GMV that breaks down into costs, and the rest is 39% comes up as revenues, okay? So that's the figure that I wanted to highlight. So the digital platform side is expected to grow year over year at the high end by 22% year over year, okay? So that's really, if you think about the business model that was growing going into Q4 of last year, you can see here, so in last year it was up 41% year over year, Q4 2020, you can pause the video if you need to, and the GMV from the digital side of the operations is growing at 22%, okay? That's the guidance that they're putting out at the high end. At the low end is 18%, okay? So if we use that estimate of the GMV, the 39% that breaks down into revenues, you get digital platform revenues 447 million, less than 450 million. The brand platform revenues 130 million. I said the in-store revenues, best case 30 million, okay? So altogether you come up as 607 million for Q4, okay? 607 million versus what analysts were expecting for 711 million. So that's a meaningful drop. What that translates is that analysts were expecting that Farfetch will be growing at 31% year over year. By my estimates, it's going to be growing at 15% year over year. Okay, so that's one part of the problem. Okay, now let's discuss the other part of the problem. After Tencent has converted its debt into shares, you get 471 million shares outstanding, okay? That implies that the number of shares outstanding has grown 38% year over year. So while the top line is growing at 41%, while the top line is growing for this quarter at 33% year over year, that means that the number of shares outstanding has grown by 38% year over year, okay? So they're diluting the shareholder at a rapid rate, and it's actually diluting faster than the revenue is growing at. So someone said to me, how do I understand when the shareholders are being diluted too much? Look at this. You're getting diluted 38%, but the top line is only growing by 33%. So you're paying management too much for them to execute in their business model, okay? So after the sell-off, and the shares at $35 a share right now, you get 16.5 billion market cap, okay? If we take the 2.2 billion that they're going to make this year up at the high end, and you estimate that it grows by 25% into next year, you're paying approximately 6 times forward sales for this business, okay? That puts it on par with Mercado Libre, that's expected to grow at approximately 35% and is priced at 8 times forward sales. Meanwhile, Coupang in Korea is priced at 2 times forward sales. So you kind of get a range here that marketplace stocks don't really trade at such a high premium, but investors were expecting that Farfetch, the luxury brand, will be growing at closer to 30%. And now you can see that it's clearly not growing at that rate anymore. It's going to be probably growing at substantially lower rates, probably in the best case 20 to 25% compounded annual growth rates going forward. So as I always say, don't pick out things that have 50-50 chances of working out. Try to look out for investments that have a 70% chance of working out favorably. And to be absolutely clear, I know that investing in hindsight is always easy, but I made this point to marketplace members in May. This investment wasn't worthwhile staying invested in. So if you want to find out what kind of stocks I'm buying right now, don't forget to check out my marketplace. It's called Deep Value Returns. You're welcome to see what other people said in the reviews, in the 5-star reviews. I help you become a better investor. Think through and build a portfolio for you. Okay, thank you for listening. See you soon.